Welcome to Guide to Wealth. Imagine you're standing in the cereal aisle of your local supermarket. Dozens of boxes line the shelves, some new, some old favorites. You notice one brand is suddenly everywhere, on TV, on billboards, even in your kid's lunchbox. You think to yourself, should I invest in this company? That's exactly what Peter Lynch believed. That the average investor, you and me, can find the next great stock. Not in a Wall Street boardroom, but right in our neighborhood mall, our grocery store, our everyday life. One Up on Wall Street, a timeless investing classic by one of the greatest fund managers of all time. In this video, let us discover Peter Lynch's powerful stock-picking strategy that turned ordinary companies into massive winners. Learn what to buy, what to avoid, and how to think like a legendary investor. What if the secret to picking winning stocks isn't about timing the market, but about knowing exactly what kind of stock you're buying? Peter Lynch, legendary fund manager of the Fidelity Magellan Fund from 1977 to 1990, turned this simple idea into 29% annual returns for over a decade. And he didn't rely on rocket science. He used a simple system. He categorized every stock into 6 types. Let's break them down, so you can start thinking like Lynch too. First up, slow growers. What they are: mature, stable companies with little room for rapid growth. Typically, large, established firms paying regular dividends. Growth rate: earnings grow at a slow pace, typically 2% to 4% per year. Why invest? A reliable income through dividends. Good during bear markets when safety and stability are valued. Caution: you won't get massive returns from these. If growth slows further or costs rise, dividends may shrink. Examples: utility companies, older manufacturing businesses, or large conglomerates in mature industries. Next, stalwarts. What they are: large, well-established companies with strong reputations. More growth-oriented than slow growers but less volatile than fast growers. Growth rate: moderate, around 10% to 12% per year. Why invest? Reliable performers that can weather economic storms. Lynch likes to buy the dips in stalwarts when they're undervalued temporarily. Caution: you won't double your money overnight. Overpaying for stalwarts can limit returns. Now we're talking fast growers, Lynch's favorite. What they are: small to medium-sized companies growing earnings rapidly. Lynch's favorite category, where the big winners live. Growth rate: over 20% per year. Why invest? A massive upside potential. Lynch's multi-baggers came from this group. Do you spot these by noticing companies expanding locations, product lines, or markets? Caution: a high reward equals high risk. These companies often reinvest earnings instead of paying dividends. Must monitor closely. Any slowdown in growth can hit the stock hard. Examples: think of an emerging brand like early-stage Starbucks or Lululemon before they became global. Fourth category, cyclicals. What they are: companies whose performance depends on the economic cycle. They do great when the economy booms and suffer when it slows. Growth rate: fluctuates dramatically, great in upswings, weak in recessions. Why invest? Timing is everything. Buy during economic lows, when others are fearful, sell during highs. Caution: easy to mistake a cyclical upswing for long-term growth. If you buy at the wrong point in the cycle, you could lose big. Lynch's tip: when earnings are at a peak, that's the time to think about selling. Examples: airlines, car companies, steel, construction materials, and home builders. Then there are the underdogs, turnarounds. What they are: troubled companies trying to fix themselves. Think of them as corporate comebacks. Not guaranteed success, but if they turn around, returns can be huge. Growth rate: not consistent. These companies often have negative growth before, hopefully, improving. Why invest? Deeply undervalued stocks that can bounce back dramatically if recovery succeeds. Caution: a high-risk, high-reward territory. Many turnarounds fail. Do your homework. Look for solid signs of change, new management, debt restructuring, or revived product lines. Examples: a department store with outdated strategies but new leadership and digital push. Last but not least, asset plays. What they are? Companies that own valuable assets not reflected in the stock price. These could be real estate, patents, brands, or cash holdings. Growth rate. It may not show earnings growth at all. The value is in hidden or underappreciated assets. Why invest? You can buy these stocks at a discount to the real value of what they own. Lynch called this finding a dollar for 50 cents. Caution. Hard to find and often require deep research. The market may take years to recognize the value or never realize it. Examples. A newspaper company that owns downtown land worth more than the company itself. A biotech firm sitting on valuable intellectual property. Final thoughts. Peter Lynch didn't try to predict the future. He just understood what kind of race each stock was running. You don't have to master all 6. Even getting a few right, especially the fast growers or turnarounds, can change your investing game. So before you buy that next stock, ask yourself, what category is this? And am I investing with the right expectations? Because Lynch wasn't a magician. He was just a smart observer with a great system. Want more deep dives into timeless investing strategies? If you enjoyed this summary, make sure to like, subscribe, and hit the bell icon for more insightful content. Happy investing!